All right, so today we're going to be talking about level 1 time frame analysis, and this is going to be intro to multi-time frame analysis and directional bias. Outside of the master pattern general methodology, this is probably the most important thing that we teach. This is really, no matter what you do, how you enter the market, your timing, things like that. The directional bias is, even if you're terrible at entering the market and timing it, this is usually what keeps you safe in the long run. So let's get into the lesson. So what is multi-time frame analysis? Multi-time frame analysis is the art of using different time frame charts to predict market moves based on probability. Why is multi-time frame analysis important? Multi-time frame analysis done correctly is what gives us a winning edge in the market. When you combine the understanding of the master pattern and multi-time frame analysis, you create an unparalleled understanding of the market that will serve as the baseline platform of your strategy and approach to trading. So really it comes down to, we have the master pattern, which is the 3 market phases: contraction, expansion, trend. So we're looking for those phases, but those phases are not enough by themselves. What we do is we marry these phases into a directional bias, meaning the higher time frame flow of money. The two married together is what creates the complete approach to what we do here, and ultimately what gives us an edge. If you're not looking at a directional bias, then you end up chasing the market every which way, and that really, again, it destroys your edge. So moving on here. So we have an example here. Daily candles are in a confirmed downtrend. We can see the ATS trend line is headed down, and that the candles are trading below it. They're not wanting to trade above it. So that would be our higher time frame flow of money in this example. And then we have a 30-minute chart off to the right here. So as long as the higher time frame trend on the daily holds short, all 30-minute price increases in the red zones return to value. Pairing defined value points with higher time frame momentum is the basis of a very powerful and repeatable trading methodology. So we just did this in the previous webinar. We talked about this. The essence of why this works is because when we have that higher time frame directional bias, we have that higher time frame flow of money on a daily basis. In a downtrend, you have those prices that are trading lower and lower and lower overall. We have some days that are up days, but the majority are going to be down days, because that's where the higher time frame money flow is going. When you pair that with the master pattern framework, we have established market value, as shown in our example right here. That alone, with the traders that are not paying attention to the directional bias, they're not paying attention over there. When we look at just the 30-minute time frame, we have breakout traders that are selling below value and buying above value. They're chasing the market. So as the market trades above those value points on the 30-minute time frame, we can come to the conclusion that they are likely to lose. Therefore, we can make a good trade with them. We are willing to sell to those traders that are trading above value because we know the higher time frame flow of money is going down. Who moves the higher time frame flow of money is the banks. And when I talk about higher time frame, I'm talking about 4-hour, daily, weekly, monthly time frames predominantly. Why do we know that the banks move those time frames? It's because of the speed of transaction. They are moving a lot more money than what retail traders move, and they can't do it in one trade. So they have to really commit to scaling into a direction and scaling out. They are also reliant on liquidity. Liquidity takes time to come into the market. It takes time to fill their book with the positions that they want. It takes time to exit those positions. If you're going to make a return on hundreds of billions of dollars, you can't deploy that all at once. I'm in a $100 billion position and then out and I got 5 pips. Doesn't work that way. So the bigger players are going to look at the higher time frame directions, see where the overall flow of money is headed, scale into those directions and scale out. And that's why we want to be grounded in those directions. So when we pair that with our master pattern framework, meaning fair market value, the reason why in this example that the 30-minute keeps trading above that value point, that established value point, and then crashing back to it, and then eventually getting through it, is because the higher time frame money is stronger. And the banks are using the flurry of buying action that comes in above those value points to fill their book of business, accumulate more positions, and then distribute those positions back below value. So when you follow the directional bias, using multi-time frame analysis approach, you are aligning yourself with the bank's momentum, and then you use the 3 market phases. You are now timing yourself with the way the banks scale in and scale out of positions according to the trend. That's it in a nutshell. That is essentially what we're doing here as an overall methodology. Directional bias, and then using the 3 market phases for timing. So directional bias, the definition is allowing the confirmed direction of a higher time frame to determine whether you are only buying or selling at any given moment. How do you determine your directional bias? There's a number of ways. For a long time, we used Heikin-Ashi candles. Simple Heikin-Ashi candle color. This goes back to 12 years ago when I started using just standard smoothed out Heikin-Ashi candles. These are good. The key to the directional bias is we're just looking for something that holds stability. Stability is the most important thing. We don't want the bias to change frequently. So whatever is the most stable is what we're looking for to control our directional bias, because we don't want to change direction. Don't want to change direction of the day. Don't want to change direction of the week if you're trading higher time frames. We want that stability to continue as long as possible. That is the goal. Then we have moving averages. A lot of people just look at where is the market trading above or below moving average. The problem with these is the settings. Are you using a 15-period moving average? Are you using a 25, a 50, 100, 200? You know, that there's a lot of variability. And with moving averages, especially if you're new to this methodology and you're watching these tutorials, a thing that you're going to have to overcome is wanting to constantly change your indicators and settings to find your directional bias or whatever you're doing. You're constantly trying to optimize. So a moving average can work, but then you're going to be fighting the temptation to figure out what is the actual best period to use for your moving average. So I don't recommend that. In fact, I think Heikin-Ashi candles are going to be better overall than moving averages because you can't adjust them. They at least are the same day in, day out. The next thing, which is the gold standard, is tracking inefficiencies. An inefficiency in a market is where you don't have a balanced buying and selling. If you have balanced buying and selling at a price, we establish value there. The opposite of an efficient market, where there's an unlimited number of willing buyers and sellers at a price that creates a contraction and expansion area, the opposite of that is an inefficient market, where the market gaps. It goes from point 1 to point 2, or A to B, up or down. That's an inefficient market where you have buyers stacking in on it on top of each other, or sellers stacking on top of each other, moving price. What do we care about as traders? What do we really want? We want inefficient markets, because those are markets that you can make money with. We're just trying to survive the efficient markets. Now, the market makers, their base business that they make all the spread on, they love efficient markets. That's their goal for that revenue stream. They love the market to stay in sideways areas with a ton of willing buyers and a ton of willing sellers, because they're able to collect tons of spread, which is one of their revenue streams. Now, the proprietary trading side of that, eventually the markets are going to become inefficient, and they're going to want to participate in the move as well. And that's where the proprietary trading side comes in. And that's really where the whole conflict of interest is in the first place. If you have all this inside knowledge into buying and the buying and selling dynamics that are happening, because you're the market maker, you're intercepting all the orders, right? If you understand that there's going to be supplier demand coming into that market, you don't have to match up all the buyers and sellers. You can take those trades in-house and fill your own storehouse. you're still fulfilling the service because that trader just wants to get in the market. They don't know if they're trading with you or they're trading with another trader though. And in Forex, that's kind of the black veil that's over it. That's why it's not fully regulated. In stocks, you know who you're trading with. In Forex, you don't. So a lot of times it's ripe for market maker manipulation, and that's okay. It's okay that the markets are manipulated. We just need to understand it. And that's what we're doing here, right? So that's a slightly different topic. I don't want to totally get off track here, but the tracking inefficiencies is where a lot of these moves get kicked off. It's that first instance of that slight gapping action, or sometimes we'll call it separation of the candle. That's how we know, okay, there's some activity here that is putting some emphasis on a new market direction, and we want to start tracking that. So we not only track the initial inefficiency, but we track the efficiencies that happen as the trend goes down or up on those candles. This, in my opinion, is the gold standard for determining directional bias. And there's two different types, which we'll touch on real quick here. There's a traditional 3-candle separation, meaning you have a candle trade, you have a gap candle and an inefficient candle, and then another candle sealing it in. And it's the distance between those two candles as highlighted by the red box. But taking it a step further, this is common knowledge. A lot of people talk about these as like fair value gaps, things like that. This is common. But there's actually a more intricate model of this, which is a group inefficiency, where you can track groups of overlapping candles. And then the candle you're on, if you look back, you look at what is the last candle that one was separated from, up or down. That's tracking group separation. And that's what we've done on ATS Trend. ATS Trend not only tracks traditional market inefficiency, but it also tracks group inefficiency as well. And that's what makes it so good, is that it takes it to that next level. So I'm not going to go too much more into that. Yeah, that's it. Is everybody so far clear on these things right here? And everyone agrees why inefficiency is kind of the gold standard. That's why we gravitate towards that. So cool. All right. Let's go into our next slide. So the benefits of adopting a directional bias are numerous, but here is some of the top ones. You have a significantly increased probability of winning more trades when you align yourself with a directional bias. The example I always like to give, for lack of a better one, is basically the gambling analogy of the roulette table. Just did it in our last webinar. I'm going to do it again right here. When we look at the directional bias and we compare that to a roulette wheel, almost half the wheel is going to be black, half of it's going to be red. If you pick black, you pick red, it lands on it. The ball lands on that spot. Let's say if you pick red, you double your money. And that's why people play, because it's a very, very simple game. What the directional bias does is it allows us to understand what the likelihood of landing on black and red is, because we can see it we could see the probabilities. Now in a casino, people can't see those probabilities. They're just kind of randomized. People think it's a 50-50, almost a 50-50 chance, but the problem is that you still get runs, you still get trends, you just don't know where they're going to come from. In the market, we see the trends shaping up. We see the inefficiencies kicking them off. So if we see a new trend form to the downside and we get a change on ATS Trend, or you spot that initial inefficiency, if you're not using the software, you spot that initial inefficiency, that's basically telling you, hey, there's a likelihood that if it's a downtrend, it's a down inefficiency, that the majority of the next spins are going to land on, let's say, black. So every time that we become overvalued on our lower time frame, that's an opportunity to put your chips down and bet black. Now, there might be a few scattered reds in there, but the majority of those are going to land on black, because the inefficiency that kicked off the trend to the downside told us that. So we have a significantly increased probability of winning more trades by following a directional bias. That's the first benefit. You're going to avoid needless losses, because when you are willing to chase the market any which way, as it breaks out and as it does different things, and you're looking at patterns on one single chart, then a lot of times the best moves are going to come in the direction of the established directional bias anyway. And if you lose track of that, the worst thing that you could do is, if the directional bias is long, you end up seeing a mirage and you get in short, and then you miss the real opportunity and take losses. It's better to just keep, if the directional bias is established long, you buy, you buy, you buy, you buy. Even if you lose a couple in there, no problem. You keep buying, you keep buying, you keep buying, and you especially do it undervalued if it's an uptrend. So the opposite would be if it's a downtrend, you're doing it overvalued. You keep selling, you sell, you sell, you sell. Every time you become overvalued. That's how you keep betting on the winning side. And you're doing it in a sound way. Going back to our previous example, in a downtrend, what are the traders doing above value? They're breakout trading, trying to catch the turn. You want to sell to those less qualified, less talented traders that don't understand how the business works. You're taking their money and moving it to your account, the same way the banks do. You're trading in line with best practices. So it's extremely important to align yourself with directional bias and then combine that with overvalued, undervalued market framework to make sure you're in alignment for good things to happen to you. That's how you're going to do it. And now every trade, again, is not going to be a winner. And sometimes you will misjudge things. But if you do this as a best practice, you start every trade from this place of directional bias, overvalued or undervalued, counter to that trend of the directional bias. You start every opportunity from that basis. You are going to be in alignment over the course of 100 trades, 50, 100, 1,000 trades to be positive overall. So very important that you adopt these things. You're also going to get consolidation of focus and effort. If you are following a directional bias and the directional bias is, let's say, short, your entire job is being a good short position trader. You are unopen to buying the market. It is not on the table for you. So therefore you don't need to worry about it. You do not need to worry about pressing the buy button. Don't need to look at any technical analysis for that. Don't need to set up any indicators for it. Don't need to do anything having to do with buying the market. You are a one-track mind of how can I effectively accumulate, sell inventory above value, ideally, and then distribute that inventory into the trend just like the banks are doing. So now you're able to be effective, way more effective than someone that is always willing to do everything. That's why they're going to lose, and you're going to take their money from their account. It's going to transfer over into your account over the course of many trades. So reduced trading and work fatigue is another thing. If you're always willing to trade up or down, no directional bias, that means you're always in a trade. And what does that mean? You're probably trading all day long if you're a day trader. And what does that mean? You're probably tired, and you're probably getting less and less effective. Much better to show up in the directional bias when things are set up, when they're in a good zone, and execute effectively. Much, much better. That's what athletes do. They rest up, they get their body ready to go, they eat right, they do everything, and they're on that field for those few minutes. Everything they do around their life is to be on that field and do what they need to do in that moment. Of course, they do train a lot, but they're not actually playing a game all the time that matters. When you open a trade with real money, you are playing the game that matters, and that's going to go to your P&L. So when you open that trade, you want to make sure that you have as much probability and as much focus and as much simplicity to execute that position as you can. These are things that you can control. And the reason why you want to do this, the reason why you'll be a winning trader if you're willing to do this, is remember that 95% of everyone else is unwilling to do it. That's the difference. All right. Next one is you effectively protect and preserve capital. If there's no setup inside the directional bias, you're out of the market. You're not losing any money. That's much more than most people can say. Most people are in a trade all the time, and most people are losing their money. You're at least protecting capital. So what feels like at first that you're missing opportunity, if you wash it out over the course of 100 trades, see who's down more. The guy that's willing to trade every direction, or the guy that only trades in directional bias. I'll tell you who has more trades. I'll tell you who's been doing more is the guy that's willing to do everything. But the guy that's been more effective, that's actually grown his account or has not lost, is the guy that's that's been in a directional bias. By far, it'll work out that way. So last thing is you get the potential to leverage up on big opportunities. The more you stay focused to a directional bias, the more you're specializing in that direction that is at hand, the more you can show up and be prepared for really, really good opportunities that will come across your desk every once in a while. The guy that's not trading against directional bias is going to probably miss those opportunities. He's just simply opened up his awareness to too many possibilities. He thinks he's doing himself a favor by always being open. He's not. The guy that shows up and comes in for the kill at the right moment is the guy that's going to win, not the guys that are running circles around the battlefield. That's it. You want to be the sniper. You want to be lying in wait for those opportunities. The directional bias makes your life simple so that you can come in and execute super, super effectively. So, next one, realities of implementing directional bias. Now let's talk about the hard part. The concept of directional bias trading is simple, yet is one of the hardest disciplines to master, simply because traders can't overlook the temptation of being in a trade in any direction, anytime. They think more trades equals more progress, means I could get rich faster. Not the case. They will be doing that for 5, 10, 15, 20 years. If you eliminate this, if you can nip this in the bud, especially if you're starting new, if you nip this right now, decide that this is not for you, that extra temptation, you are already way ahead of the learning curve. Way, way ahead. Most traders give up on directional bias after only a few losing opportunities or getting caught in actual reversals. It's very tempting to feel like I am executing directional bias, and then the market does get in sideways periods and you're going to take a few hits and they say, forget it. And then they abandon it, they go back to the old ways. The key, the good players stick through the sideways markets, they stick with their time frames, and they're ready to catch those trends as they break out. That's it. They're not opening their mind to more possibilities, more strategies, more this, that, whatever. They stay true to the course for years and are ready to execute. So again, this is their fatal flaw, and it could be your edge if you can commit to this one thing. Everything that I'm telling you through these series is not only teaching you a methodology that's based on sound principles at the end of the day, trend, 3 market phases, established market value. These are actually basic concepts. But again, if you are going to take money from other people's accounts, mostly the bank's account, and move it to your account, you have to think completely opposite of how the losing traders think. And that's really, as we go through this class, as we go through these lessons, you should be taking notes on what do the masses do, and then come up with the exact opposite is what I'm telling you is going to be your strategy. Masses are unwilling to commit to directional bias. They are unwilling to commit to the same time frames. They are unwilling to trade smaller positions if we're going to really take inventory of everything. They're unwilling to layer in with smaller positions just like the bank does. They're unwilling to do that. They are unwilling to trade one pair and specialize. They are unwilling to do all those are the main things, but they're unwilling to do those things. So those things, if you are willing to do them, automatically puts you in line to take the money from their account and transfer it to your account. Will you do everything perfect? No. Will you make mistakes? Yes. But this, what I'm telling you now, needs to be your home base. This is where you want to live and always come back to as your grounding point. All right, so what's the takeaway from this lesson? By committing to one side of the market, you become a better competitor than others who are unwilling to do the same. By being open to trading both sides, you limit your effectiveness. No one can pitch and bat at the same time. You can't throw the ball, run up and hit it. That's what trying to be a buyer and seller all the time means. If you're only a pitcher or you're only a batter, you can get better and better at filling that position, right? Knowing the overall direction of money flow allows you to anticipate moves on the lower time frames before they happen. A lot of our entries, we're looking for that trend phase of the market, but no one knows when it's going to happen or how long it's going to take. So a lot of it is just getting yourself well positioned in anticipation for that move to kick in. Where do we know likely where that move's to happen? The directional bias, the higher time frame flow of money. That's where the power is going. So we are just trying to get in the market at a safe price that'll likely put us in the money so that we can sit there and bake and wait to be in the trend phase. By the time the trend phase hits and it breaks out, it's already too late. That's not a safe place to enter. We are accumulating positions for an expected outcome, and the expected outcome is based on the directional bias. The ultimate strategy is trading against traders who are betting against a higher time frame trend. That's where overvalued, undervalued comes from. We know the tipping point based off of fair market value. How do we know fair market value? Because they established it. Accumulated buying and selling. Of course, the fair market value can be manipulated because it's only allowed by the market makers. So, but nonetheless, it is a balancing point, and people can see that balancing point visually. They start interacting with it knowingly or not. So as they trade above a balance point, the likely reaction is to buy. As they trade below, the likely reaction is to sell, because everybody wants confirmation. They don't want to anticipate a move. They want to see it happening and join it. That is also a bad idea, because a lot of them come back into the range and they take losses. So the master pattern is really taking that foundational understanding that most people get themselves whipsawed, harnessing that pattern and studying that pattern, the widowmaker pattern that kills most traders. We embrace it and we work from that as a basis point. We start there. We find that pattern. We map it. And then we use that pattern because we know that's where traders are suffering the most losses. And we use that to position ourselves. We're doing everything opposite that they're doing. Non-biased traders end up getting caught in false moves that wipe out gains much more often than someone who's committed to a directional bias. And that's what we want to do. We want to do the opposite of that, right? We want to commit to the directional bias because that's going to set us up for the big moves. We're going to be opposite positioned of the traders that are buying the breakouts above or below value on the lower time frame. And that's what's going to put us in line to take their money from their account and siphon it into ours. And over a long enough period of time, even not being perfect at that, you should be net positive. And that's a baseline. If you start with this as your baseline, that is a platform that you can build skill on top of, because it never changes. It's the same every single day on every single time frame and in every single liquid market. So if you get good at that and you stay on the same time frames, you stay in the same market, no one will be able to compete with you because you're a specialist now in what is best practices, and you're aligning yourself with how money is actually made in the market, which is taking it, at the end of the day, the essence is taking it from less skilled traders. You're taking their money, they're getting experience. You don't want to be the one getting experience and someone else taking your money. So start from today to align yourself with the best practices, and that is over the course of your career in this business. That's how you will get the most good outcomes over time, is by staying true to these best practices and principles. All right. So do any of you guys want to ask any of these questions? Go to Rachel. All right, Bowden's got one. All right, thanks. You got one for me today. I'm going to go ahead and unmute you and go ahead and ask.
Okay. Hello, everybody. So I get the idea with the directional bias. But is there a master pattern that is fractal in nature within that higher time frame bias? For example, like, is there a 5-minute master pattern within the higher daily time frame? And there's two parts to this question. And then secondly, are we taking the opposite side of the retail traders because we are trading in the same direction of that higher time frame bias? Because all of us are using the master pattern, right?
Mm-hmm. Yeah, absolutely. It's a great question. So let's go ahead. I'm going to actually pull up the chart here for a second. And because we've had on Eurodollar, we've had some great examples of this. So talking about in a 4-hour directional bias, talking about, is there master patterns operating within that? And yeah, of course, that is the nature of what we're doing here, is finding those master patterns inside that time frame. So if we look at this, we'll just look at it from the daily here and the 30-minute. The higher time frame flow of money was confirmed here on the 30-minute chart when we broke out down and we confirmed with ATS trend. This is that first instance of inefficiency. And for the last 16, 17 days, we've been short, trading short. So we're looking at from that point, which was back right here, we have these master patterns here that are forming on the lower time frame. And so we have the expectation that the flow of money is going down based off of this kickoff inefficiency and the fact that we're trading below ATS trend. So what we see right here is the whole business in practice. We see the market trading above established value. We have one right here. As it trades above, this is where traders start buying. And that's where we want to start selling. So not only do you have traders that have sold coming down through here, but their stop loss, their ultimate pain threshold, according to this localized framework, is going to be above this high. And that's why we have liquidity there. So as they're selling, then their stop losses are stacking in here. That creates buying and buying. And then as we get above value over this box, that's where you get new traders starting to come in and buy right here. So that's what we talk about, is that we're swapping with those traders. We want to trade with them because they have a high likelihood that they're going to lose. And so it's not the traders. There are going to be some retail traders that are following the trend. What we're trying to do is every trader that follows the trend is going to be in a much better position, regardless of looking at master pattern framework or not. They could be trading their moving averages, crossovers, MACD crossovers, you name it. There's a million indicators that traders can put on this chart to figure out how to trade short. And the ones that stick in the directional bias are overall going to do much better. What we're trying to do is find the value point, because we know the traders that are coming in over there, we're trying to find those little batch of traders that have totally lost track and have gotten enticed by what feels like a reversal. So we're not trying to find every trader or trying to trade against all the masses. We're just trying to find at least a small group of them that have totally made the wrong decision. And we know that based off of this tipping point of value. We know that little patch of traders in here are starting to make the wrong decision. And those are the ones that we ultimately want to target. So same thing right here. When we come above value, a lot of flurry of buying action, not only stopping out. Remember, anyone that's sold here, what's the opposite of that? On this liquidity line right here, the opposite of that is buying. So it's putting more buying into the market, and then you have traders opening new positions coming in here. It's all buying. It's all buying demand. So we want to sell to that. In this area, they have totally lost track of the higher time frame flow of money. The way the banks are driving it is this direction. And again, why are they doing that? Is because the speed of transaction that they need. They're not dumping in 100 billion to short right here. They're dumping in a million, a few million. They're trying to accumulate as much as they can right here. They're going to accumulate a little bit more right here. They're doing it from the traders, ideally, who have mostly lost track of where the real flow of money is going. So we're targeting those traders. Does that kind of answer the question?
Yeah.
All right. So same thing as we come down through here. We have all these master patterns that happen. And when we are looking at this higher time frame directional bias, every single time we get a box, we have a predetermined expectation of the trend phase of that box, that origination point. Do we know how many expansion legs, how much whipping activity we're going to get? No. But we have a predetermined conclusion the moment we get a box that the ultimate expectation of the trend phase is going to be to the downside in this example. And so every time we get an expansion leg, we're trying to position ourselves to the best of our ability, trading with those traders that have lost track of the higher time frame flow of money. We're trying to position ourselves against them, but in a predetermined conclusion that the trend phase is going to be to the downside. And we're going to get traveling from box down to lower box, from box down to lower box. We want to catch that meat in the middle. So we're just trying to position ourselves to the best of our ability to be in alignment to have that good outcome for ourselves. So cool. Any other questions? All right. So we got another question from Joel. Go ahead and ask your question, Joel.
Okay, thank you, Wade. My question is, if someone is trading the 5 minutes into the 4 hours and the 4 hour keep changing direction from long to short, what do we do? Like, for example, the euro dollar for, I can say from the 18th to date, it has been changing direction, long, short, long, short. So what do you do in such situation? Thanks.
Absolutely. Thanks, Joel. Appreciate the question. All right. So what Joel's talking about is when we get in situations like this, where we change directional bias, you can see on ATS trend, we get a new direction. Then right here, it goes back up through. Now it goes long for a few candles. Then it changes, it goes short. And so what ends up happening is we get in this whippy situation. The moment that you realize that you're getting into this, number one, what you want to look for and be open to the possibility is if you've already had some good movement down. So you can see the 4 hour, we had some good movement down and then it went sideways. Didn't necessarily get a box, but there are contractions and expansions happening on lower time frames, like the 30-minute, which we looked at just previously, inside this area. So we may not see a box, but that's what's happening behind the scenes here. So anytime you see a nice move sustained on your higher time frame, be open to the possibility that we could be going into contraction and expansion, and it could get kind of whippy. So what that means is probably if you're trading, this is your directional bias. If you're using the 4 hour, you're probably going to trade long in here because this could have been a reversal and could have come back up into here. So nothing wrong with that. But you're going to probably take a loss right here. Okay, maybe you trade it again right here and then you take another loss coming up through here. When you take two back-to-back losses, and you also notice if you're using ATS Trend, if you are using our software, you notice that we had a long directional change here, and then we had a short directional change right here, and then it has been ignored, then you can start to define between losing on the buy side or not having a real stellar move on the buy side, and then also not having a great move to the downside either. You start to reason that, okay, potentially we're in a sideways market. So what you can do, here's a technique that you could do, is you can take your 4 hour, if your directional bias is whipping you out of trades and you're still following, and it's good. There's nothing wrong with taking losses to figure out this information. It's part of the game. The idea is to make a lot more on the sustained moves and have the budget from your wins to figure out information. Losses should always give you information, and we've gotten information in a situation like this. What you can do is I'm going to put your directional bias over here for a moment. Okay, here's our 4 hour. Here's that same activity. Now, since we've gotten smacked a few times right here, what you want to do is up your directional bias. Look at the daily or even maybe the weekly. And use this to navigate out of the whips. What's the whole point of a directional bias? What do we really want? We want stability. And if our directional bias is not giving us the stability we want, let's move up one time frame. And then what that's going to do is it's usually going to give us a little bit of clarity. And so what happens now is we want to, now that we know the daily is short, and at this point the weekly is also short as well. I'm pretty sure it was at this point. Maybe not. But the daily is short. So that's enough to give us some stability. We have this line holding. Now what we want to do is be a little more careful on the long direction, but then trade the short direction in direction with the daily. So I'm not saying don't trade the long, but keep in mind that the probability may not ultimately fully be there yet because the daily is still short. So in conclusion to Joel's question, if your higher time frame starts whipping you and you've paid to get some information that it's choppy, move up one time frame and see if you can reclaim some of that stability. That's the entire point of the directional bias, is to not change direction. You want to change as little as possible. So we will have a lesser expectation on the long side as we do on the short side. And that hopefully would have led you into this move right here. Because remember, the higher time frame is always more powerful than the lower time frames. That's where the sustained money is. And that's where the next level of stability is. Once this kicks in, then you'd be looking for your 5-minute trades, as you get below, and you're just trading that. So at least you're not losing on both sides of the market. So again, I'm not saying you can't trade the long, but you're going to have a predetermined expectation to help smooth out that original directional bias time frame by borrowing some of the stability from one higher time frame above. So does that answer your question, Joel?
Yes, thank you.
Yep, thank you. All right, so that wraps up this lesson, and hopefully those of you guys that are watching had some good takeaways. Just make sure you stick in that directional bias. I can't say much more than that. You can get real fancy around that. We have the master pattern, we have ways to enter, we have all those different things. But at the end of the day, if you just from today forward commit to understanding the directional bias and trading and building that into your plan and making it a pillar of the best practices that you choose to follow, that's really going to be what helps you be positive over the course of maybe not one trade, maybe not two trades, but over the course of your next 10, 20, 50, 100 trades. That's what's going to make you positive, even if you're not totally perfect on your entries.